Are you concerned that we might be in a stock market bubble? Maybe you think that this is for a specific stock, or maybe it might be for a specific sector like the tech sector. Well, in this video, I'm going to explain to you why I think we might be in a tech bubble, and why I'm still holding in spite of this. All of that coming up. Hello and welcome. I'm Wayne from WES Investments, bringing you stock market news, portfolio updates and training on how to make money in the market, all on this channel. So if you're new here, consider subscribing, hitting the bell so that you're notified of all my new videos. Now, boring bits first, I'm not a financial professional. This is not financial advice. Everyone's financial situation is different and you should not consider this or any other video you find on YouTube as financial advice. Now, there has been a lot of talk for months, well, practically since the market started recovering from the global pandemic, that the market is recovering too quickly, that there is too much money in the market, that the Fed is pumping too much money in. Companies that have had high price to earning ratios before the pandemic now have considerably higher share prices and unheard of PE ratios. It is fairly easy to see which companies these are that are so incredibly overpriced. These are often what is referred to as tech companies, and if you take a look at my stock portfolio, you will find most of these stocks that I own fall into this category. Companies like Tesla, Fiverr, Alibaba, Nvidia, but also companies that I don't own like Facebook, Microsoft, Apple, Google. You get the idea. So the issue that we have at the moment, there are very low interest rates globally, which means people have more access to money to invest in the stock market, while at the same time people with money are finding it pointless putting their savings into the bank and instead are trying to invest it in the stock market. There is global growing interest in the stock market as well, with new millennials being very interested in trying to invest, as well as younger generations, the millennials as well. Especially since the pandemic, meaning even more people are trying to get invested in the stock market. So we have a huge influx of money coming into the stock market. What is it that we know happens when more people want to buy a stock than want to sell it? Well, the price goes up. This mounting pressure is pushing stocks much higher than they would normally be. This can also be seen by looking at the price of gold right now. There is so much fear that the market will collapse that people are pouring money into gold as well. I mean, it's either that or people just don't know where to invest money anymore and they're just sticking it in gold because that's what everyone talks about. Right now the market is crazy and in many respects it makes very little sense. All of this points to a bubble. So if you think we're in a bubble, the normal actions are either you close and move into cash or gold, as many people do. You close everything and open short positions, or you find a good hedge. Now, those of you that know me will know I am far from normal. And to me, those three options just don't sound like good ones. To me, sitting on cash is a wasted opportunity and I don't like doing it. And it's the same with gold. Opening a short position when we don't know if we're going to be at the peak yet, or when the peak will even be, just seems like a terrible idea. You might get lucky, you might lose a lot of money when it crashes out. If it crashes out before we reach that peak. Okay, and the guys from The Big Short that predicted the 2018 crash, if you look at them, the main guy from that was actually so close to bankruptcy and having to just completely give up. He was actually really lucky that the market collapsed when it did, because if it had lasted much longer, he would have missed out and he wouldn't be the famous person that he is now. And as for a hedge, I just don't see them being worthwhile. Often they are little better than sitting on cash, because no matter what happens with the market, you just make less money than you would have before. That is just my experience. Obviously there's plenty of people out there that seem to be very successful at using hedges. I believe that often they would have actually made more money if they hadn't used the hedge and if they'd got the situation right in the first place. To an extent, I kind of see the hedge option as being a little bit of a lazy one, much in the same way as investing in an indice or investing in a very broad range of stocks. So this is what I'm going to do. This is a strategy that's worked for me in the last crash and that I hope will hold well if this current bubble does burst. And I want to stress that's if, because just because it's a bubble as such doesn't actually mean it will burst. It can bubble up and then the rest of the market kind of catches up and the bubble's fine. Okay, so if this bubble does burst, that is when I will react. And the strategy is simple and it works for us because we don't have the same liquidity issues on eToro that larger investors might have. So we'll hold the stock when it bubbles up, we'll get all those lovely gains as it gets higher. Then when the bubble bursts, for the whole market, that's when we'll close. Okay, because this won't just, if this bubble bursts, it's not just going to affect the tech industry. It will mostly affect the tech industry, but the whole market will be brought down with it. And if that happens, that's when we'll close. This means that we're not going to get out at its peak, but I do believe that we will make the most money from this way. Then, when the market as a whole starts to drop and move into a bear market, we're going to close all of our long positions and open short positions on companies that I believe will get poor results even if there is no crash. There is normally what is called a dead cat bounce, and this makes it seem like the market is recovering, and it normally results in a much bigger fall. So ideally I would close the shorts for the bounce and then open them back up again. But that is also very hard to do, and if you miss that optimal point in the bounce, you're better off just holding those short positions and letting them bounce up and then watching them drop. I just want to go over the criteria for the short company. In a crash like this, the type of company that I would short is not the company that is most likely to drop the most. The reason for this is the companies that are going to drop the most are going to be ones that have climbed the highest. They're most likely to be companies like Tesla, Google, Apple, Microsoft. They're ones that have got these quite high price to earning ratios. They're the ones that are going to kind of drop significantly from their highs and then recover quite quickly. And that's what we need to avoid, is because of the fact that because they drop very harshly and then recover very quickly, we can get burnt quite easily. Not only that, but it could also be a false drop. So it could start to drop and then suddenly recover, and we're obviously caught with our pants down. So that's why we have to be very, very careful with those companies that we choose to short. On the flip side, one of the companies that's in a bad position is far less likely to recover as fast. And if it is a false crash, if the bubble hasn't actually burst, then if we're shorting a company that's going to go down anyway, it should mean that that should still end up being a profitable transaction. So then moving forward, when I think that we've reached the bottom, I'll then start to buy back in slowly. So I'll start to close down some of the short positions and I'll start to open back up the long positions. That will be done slowly because to an extent it may end up being when the stocks are still dropping. However, most of the long positions will be opened after the recovery has started. So I may well end up missing buying in at the very bottom, but as long as we buy in somewhere near there, we should be able to maximise the potential. Obviously, all of this is just in theory. It is what I did in the last crash, so I hope that I can repeat it here. I hope that all makes sense and I hope you've enjoyed this video. If you have, please hit the like button and the bell so that you're notified of my next upcoming videos. Thank you for watching, and I hope to see you in my next video.